February 16th, 2024. I wanted to talk about this really quick because I thought this is kind of, this is kind of the essence of trading ranges right here, bars 43 through, 47. So you get a big bear bar on 43, right? And it's a breakout below, you essentially have bulls trying to get some sort of wedge pullback here, and you get a breakout below the wedge, and bears want the measure move down to here. Additionally, you have this gap, which is, basically on 14 what started. So we'll probably get back to the 13 high at some point today. So you look at 43 and you think, well, it's probably reasonable to sell 43 looking to get back to here or, maybe lower. I'm not sure, but probably an okay thing to do. And if you sell 43, you get 44 as follow through. And what should you be thinking when you see 44? Well, the concern with selling 43 is that it's a bear trap and that you're going to get a bull bar closing near its high and traders will exit and bulls will buy looking for a second leg up from that. And you get 44. And I think personally for me, 44 is enough for me to want to get out above 44. And the trader, so traders will put their stop above 44. They're disappointed in how strong, or then the fact that it was a bull close. 44 being a bull close was really important, showing that it was bad follow through for the bears and reminding traders that it's still a trading range. And then we get 45 and it goes to 2-to-1 of the true risk of the bears, and the bears just scalp out, right? So you get 2-to-1 true risk on 45 and those bears just scalp out, and that causes the big tail on 45. Sometimes what will happen is you'll get sellers directly above 45 and then you'll start to get a bear bar closing near its low, but then you get a disappointment bar on 46. Now, if you think about it, this is the spike, right? So 43 is the spike, and then essentially 44 is the pullback. And so what do you want if you're a bear once you see 45? Well, you want a bear channel, right? So you know that you're not in the spike phase anymore. 43 was the spike phase. Now you get a pullback, and if you're a bear, you're hoping for a bear channel, and you're hoping for bear closes. But I think it makes a lot of sense to put your stop above 44 for exactly this reason. What's going to happen here is on 46, it isn't a bear bar. It was fight. You could see traders fighting over this close real time, and it ended up being a small bull bar. And what traders are doing is they're thinking, well, we had one chance to go down, and it failed, and now this is our second chance. But this low one, it's really not very good because it's a bull bar. So they see that and they start buying back shorts at the market. And when they're buying back shorts at the market, they're doing so knowing that we're probably not going that much lower. If we are, they can sell again below a bear bar closing near its low. And they know there's risk of a bounce here because we're just relatively low in this point, what's probably going to form a trading range. The trading range being starting at maybe, bar 19, since this was a channel. And the bottoms of channels often get tested. And that's one of the reasons why it was okay to put a stop above 45, because you're essentially putting your stop above the top of the channel. And as this starts to bounce, more and more traders realize that their premise they were short is wrong, and that we could easily get a huge rally here because traders are going to start to exit. That's exactly what happens on 48. So my overall point being, in trading ranges, you want to sell below 43 and think, okay, I'll just exit above the bull bar if it closes on its high. But if you actually just do that strategy, you're going to get out all the way up here and you're pretty much going to take a full loss on the trade. And that's exactly what you can't be doing. So, if you're going to sell 43, if you're going to take trades like that, I think you need to be faster to get out. You need to get out, somewhere in here. I did sell 43 and I just got out, as this bar was starting to bounce somewhere in here. Oops. But even that, I thought I could have probably gotten out even sooner, maybe taking a piece off at 2-to-1 of true risk during 45, or just on the close of 45 when it was disappointing. So, but that's kind of what trading ranges do, is that you'll start to get a bar like this and you're just hoping it doesn't get too big so that, you lose so much money, and then it just keeps getting bigger and bigger and bigger. And then you end up exiting all the way up here rather than down here where you should be. Anyways, bar one, a bear bar closing near its low. It's a good bar. Overall on the daily chart, we had a pair of buy the close bars. These are technically buy the close bars, but you're so high in a range, it's really not all that good. I thought this bar would probably get bad follow through, and I thought there would probably be, I think I might have mentioned yesterday, I thought there'd be sellers above this high if we got there. But that was kind of my thought coming into the day, was that we're probably not going to get another bull follow through bar because channels usually only last 2 days. Follow through for the bears on 2, but if you sold below 1, are you thrilled with bar 2? Not really. I think if you sold below 1, you wanted to see another bar that looked exactly like 1 and start to get a massive bear sell-off. But in reality, you're just kind of getting a doji bar. Another doji bar on 3. So again, really not as good as it could be. And then another doji bar on 4. Again, do you really want to be short down here? I think there's too much risk of just a bounce, and you end up getting, because this is the top of the channel, right? Spike and then channel. So this is the top of the channel. And traders are probably, it's very possible we test all the way up here. So, a lot of times here, I think it's okay to just get out. And that's what a lot of traders did. But you can see we ended up getting a surprise on 5. I think if 5 is a low probability surprise, I wouldn't take any of these sells personally, but they are theoretically reasonable. Big bear bar on 5. Can you sell below 5? You probably can. My problem is it could be a big second leg trap. You have 1 pullback, maybe 2, something like that. So it could be some sort of bear trap. So if you're selling below 5, what you're really trying to avoid is a bull close on 6. And you can see we ended up getting a bear close on 6. And what essentially happened was traders knew that, well, first off, bar 7 often has like a dramatic move. And traders knew yesterday's low was the target. And traders saw a bear close on 6, and they just sold the market. And that's what caused 6 to drop basically like 10 points in like, I don't know if you were watching 7, but in the first, 15, 20 seconds of the bar, it was all the way down here. And when that happens, you kind of have to just think about it. If you're looking at a 5-minute bar, think about how big these bars are, and if the bar is down here after like 10 or 15 seconds from here, you still have well over 4 minutes left in the bar. Do you think this is going to be a bear bar closing, basically if it kept up at that pace, it'd be a bear bar that's closing like all the way down here, that just never happens. And so, your best case scenario is probably it closing somewhere down here. But the vast majority of the time, I think when you get those quick dramatic moves, traders sell the close of 6, they made 10 points in 15 seconds. You know what I mean? So a lot of those traders are just going to take profit. They knew this was the target and it got there in like 10 seconds. So they just took their profits. And that's why you got all that buying on 7. Can you buy above 7? Maybe for a swing, but I wouldn't take it. I think that, it's just too big of a bar. You want a smaller bar if you're going to be taking that. Follow through for the bulls on 8. It's okay. It's probably okay to be long, but this is really steep. So if you're buying, you have to realize you're going to get a pullback and you're going to end up sitting through a pullback. 9, tail on the top. It's a tight channel for the bulls. They're hoping to, get a tight channel up. That's their ideal, scenario here. But the reality is we're probably going to find sellers if we get up here, especially if we go straight there, because the first target when you get this reversal is the top of the most recent sell climax, which is the 5 high. Follow through for the bulls on 10, but this is kind of getting a little parabolic. If you look, it's starting to try and break out off the top of this channel, and it's probably just not going to succeed. We're going to get another leg down. That's exactly what happens on 11. You get the second leg down for the bears. Inside bar on 12. Do you buy above 12? Maybe. It's a high 1, and you could argue that 11 is the retest. The problem is you're buying kind of high in a tight trading range if you buy above 12. So if you buy above 12, you want 13 to be a big bull bar. You want 13 to look the way 14 did if you were going to buy above 12. 13 ends up being an inside bar. So, theoretically, if a bear sold the close of 11, they're disappointed 12. They're getting out around break even during 13. And you have an inside pattern 12-13, which is a breakout mode pattern. You could, in theory, place a stop to buy 1 tick above 12 and sell 1 tick below 12. But I would just rather wait and see the breakout, because a lot of times the first breakout is going to fail, and then you can trade the failure. And then you get a big bull bar on 14. If 14 was a smaller bar, I wouldn't buy above it, but it got unusually big and closed strongly above the moving average. And, it's right on a lot of resistance, so it might not be the best buy in the world above 14, but I think it's definitely credible. And you get disappointing follow through on 15. I think it's hard to hold long if you buy above 14 and you get 15, because I think there's a lot of risk that we can test all the way back down here rather quickly. So I think a lot of traders will start to sell. And that's exactly what happened, and that's what caused, the big tail on 16. We started to rally, and traders just took profits, and then you got 16. 16, a bear bar closing near its low. It's potentially, a two-legged correction from this. It probably would have been a reasonable sell if it triggered, but bulls bought the close of 16. Why are they buying the close of 16? Well, for one, this bull channel is unusually tight, right? This is tighter than the vast majority of, bears are hoping that this is essentially a bull or bear flag, and it's a couple legs up. And, you could argue, since it's a channel, it technically is a bear flag, but it's really tight. And so it's probably better to actually be long at this point. And you got to be thinking, we failed, break out to the downside. There's a pretty reasonable chance we go outside up today, and 90% chance we break out of the 18 bar range. And it's only bar 14, but you can be pretty confident the 18 bar range is pretty much going to be this. And so if you're buying above here, you can be looking to get to the high of the day. You can be looking to get towards outside up. Those are your targets essentially. And 16 closes near its low. Bulls buy the close of 16 and just put a stop directly below 16. They know all the bulls have a stop 1 tick below 16, because bulls are going to exit since 16 closed on its low. So traders bought the close of it, and they ended up not letting it trigger. 17 closes on its high. Do you buy above 17? I would buy above 16. So I would buy the breakout above 16 rather than directly above 17. It's only a tick or two higher. And a lot of times the market will try and create a perfect double top like it did right here. It ended up just being, towards the bottom of a tight trading range. But if you bought above 17, you were trapped pretty quickly on 18. So I think it made a lot more sense to just buy one tick above here or buy above the bull bar closing near its high, like 19. But, a lot of times the market will try to create a perfect double top here. So it just makes more sense to trade the breakout. I think you can buy above 19, good bull bar closing near its high. And again, look how tight this bull channel is. This is really good for the bulls. What do they want? Well, they want to break out. Essentially, bears tried to create a wedge here, and they tried again here, and they failed both times. And now we're getting a breakout above that potential wedge. So the bulls want to measure move up to here. And not really a surprise, the measured move, I think I'm one tick shy here, but essentially not a surprise, the measured move leads you pretty much exactly up to the high of the day. And a lot of times that'll happen where the computers will create measured move targets based on, current profit targets. And that's why you find profit taking in those areas. Follow through for the bulls 21 or 20 by the close, follow through 21, still by the close. Also important, I thought that the bears who sold above 9 during 14 got trapped, and they were never let out around break even. So they had to start exiting and accepting their loss, and that was a lot of what caused this rally. We got a breakout above the 18 bar range on bar 23. So these were all by the close bars, and it was okay to be long, but maybe just, you have to be quick to get out because it's probably still a trading range, right? This is a really tight channel for the bulls, but it's probably still within a trading range, so you have to be quick to get out. Inside bar 24 and a failed breakout above the high of the day again on 25, but not a good low one short, especially after all this. So probably buyers below, which there is during 26. 26 is a high too, but it's a doji bar, so maybe not the best buy. Good follow through for the bulls on 27 and then a bear inside bar 28. I think the vast majority of bulls are going to get out below 28 and just look to buy a correction. The move is probably over and the bulls have accomplished a lot, so I don't see why they wouldn't step aside for a couple legs. Obviously, probably not great follow through on 28 since it didn't close near its low. So disappointment 29, and then a failed breakout of the high of the day on 30. Inside bar 31, bulls are hoping that this was enough to reset the market cycle. When I say that, I'm saying it's essentially talking about breakouts. When I say this, I'm hoping this is enough for the bulls to reset the market, or the bulls are hoping this is enough to reset the market cycle. They're hoping that basically that this, is its own new thing and it's not necessarily a part of this wedge. So they wanted it to be a really, really strong breakout. But the reality, it wasn't all that strong. Look at this. This was better. You had bigger bars. But these were, you had a lot of bars, but they were just smaller. So it's probably not as bullish as it possibly could be. It might be as bullish as this with this inside, this tail, this tail on this bar. But this is generally, really good bull bar. Really good bull bar. These are good bull bars. They're just not very big, especially relative to the size of the big bear bars we've had today. So, if you had a bar like 14 and then 15 looked like 14 and then 16 looked like 15, so you basically got 3 of these bars in a row, that would completely reset the market cycle. And it's a spike again, and we're probably going to go spike channel trading range again. But, this was just not as strong as it could be. But we still, technically spike, pullback, channel, trading range. So 31 bull inside bar, but the bulls probably already had their chance to break out to the upside. Always in bulls might buy again above the bar, but I don't really think it's all that great. Bear bar closing near its low on 32. I wouldn't sell it. You're selling the bottom of a tight trading range, and your follow through is probably going to be limited. That's exactly what you get on 33 and 34. You get follow through with big tails in the bottom. So it's really not as good as it could be. We're probably going to bounce a little bit back up towards this area, but we're probably going to due for a deeper correction. We could get some sort of midday reversal. I was relatively bearish at this point. I didn't think we were going to get a big second leg up. It was possible, but I didn't think it was going to happen. Follow through for the bulls 36, and you can see 37 though. Any of the bulls who bought anywhere up here disappointed, and they're getting out. 38, bad follow through for 37, big tail on the top. Bear bar 39, but an inside bar, and then a reversal attempt on 40. Hoping it's 3 pushes down and bulls are going to resume, but you get disappointment 41, 42, and then bulls start giving up and essentially expecting a deeper correction. And that's what causes 43. 43 is a give up bar. It's bulls selling. So you can take it, but if you're selling 43, again, you're thinking, there might be buyers and there's a move. And if you're selling 43, this is bulls selling. So you're taking a chance that bears are going to sell as well, which isn't unreasonable. You have a big double top with this, a failed breakout, basically almost outside up, but failed. So I don't think it's unreasonable to sell 43, but when you get this as follow through, you have to be quick to get out, like I mentioned. And then you get a big bar 47. 47, big up, big down, so probably big confusion. So not really willing to buy above 47 personally. I think there's too much risk that sometimes you're going to get a big second leg down from the Bears. So I wouldn't buy above 47. Disappointing follow through for the Bears on or for the Bulls on 48. Inside bar 49, high 1. Probably okay to buy above 49, but aggressive. And then once you get 50, 50 breaks out above the 48 high. So it's easy now for bulls to want to buy. You can buy above 50, put a stop below 48, and go for some sort of measured move up. You could argue, leg 1, hopefully leg 2. Someone asked what measured moves I choose to use. I'll sometimes start my videos talking about measured moves, but I just mostly look for those at the end of the day. The reality is measured moves are everywhere, and you can use pretty much any measured move. And, when you're, so like, you can use that. I try to generally start with the most conservative one, right? So they should be used as profit targets. They're not necessarily places to, like, if we go here, set a limit order to sell. It's not, you shouldn't use them that way, but you should use them as places to take partial profits. And I generally use the most conservative one, depending on context. Follow through for the Bulls 51, reversal down 52, but not closing, and it's a good enough close that I think Bulls will exit below 52, but I don't think Bears are going to sell. And you can see same situation as over here. Bulls bought the close of 52, knowing that other traders would exit below, and that caused 53. Good bull bar 54, 55, breaking out of the top of the channel. If we were going to continue to rally, 55 would have closed on its high. So Bulls were buying here, hoping that 55 would close on its high, and they got a disappointing bar 56. And more disappointment 57. I think Bulls exit below 57, expecting a couple legs sideways to down, and we're probably going to get back to at least this high. Bears who sold above here should get out break even. Doji follow through 58. This is probably going to go more sideways than down because of how strong this is. 59 inside bar, bad follow through, and then 60. More follow through for Bears 61, but I'm not selling. That's too much of a tail. More follow through 62. It's probably sell the close on 62. So you could sell the close of 62. And if you get a bull bar 63, you just get out. It's probably a reasonable thing to do. And you're taking a chance that this is a trading range day. It's also a big wedge, right? 1, 30, 57. So it's probably okay to sell the close of 62. And if you get a bull bar, you just get out. And you're taking a chance. Maybe we close this gap. Maybe if you're lucky, all the way down here. And then you get 63 of everywhere closing near its low, an inside bar, reasonable swing trade, and just everybody sells it. And, what's a general swing profit target? 20 points. So you need the market to go 20 and a half points past your entry price to make 20 points. And look, it went exactly 20 and a half points on 64 below 63. And then it found profit taking. Why? Traders made 20 points in 5 minutes. When that happens, traders are usually just going to take profit and, move on to the next trade. And that's kind of exactly what happened here. An inside bar, 65. We almost had an inside pattern, 66, but it got bought up at the last second. So traders, if it was an II after a sell climax, it would be a more reasonable buy, hoping for some sort of bounce. But this is so strong that it's hard to want to buy against it. Low 1, 67, but low 1s usually lead to deeper pullbacks. And so I get bad follow through 68, and you don't want to sell below a bull bar 69. So this is just a tight trading range. 70, a bull bar closing near its high, but you're buying kind of the middle to upper third of a tight trading range. And you're buying after a huge bear spike. So I don't really think it's all that good. The bulls who do buy, probably disappointment here, disappointment 72, and Bears can sell again below 74, looking for a swing down. Now, I mentioned yesterday I thought the open of the week was going to be important too, and that's another reason why I thought this sell-off started this way, was because traders, I think everyone was expecting a bear close on the weekly chart, and so traders just started to exit, and that's what caused this. Bulls give up on the thought of a bull close. For stop orders today, you could theoretically buy above the II, but I'd wait. You probably could have bought 14, 17. These are all by the close bars. I think you could sell 43, but you have to get out somewhere in here. I thought these were okay by the close bars. And then you could probably sell the close of 62 or just sell below 63. And you could sell below 74 if you're still trading. On the daily chart, disappointment. It's a double top. We're probably going below the moving average. We're probably getting back to at least this high, I would imagine. On the weekly chart, a bear close. So we'll be interested to see next week if we get back to this high, if bulls sell and cause a big bear close. So I pay attention to the price of this close and this high next week and see what happens when we get there. Only a couple weeks left in the month. I have been saying I think this is going to be a disappointing bar for the bulls, and I still think that's true. So we will see what happens. This move on the 5-minute chart is probably going to be enough to influence the market for a couple days. So we'll see where this goes. And one more point, I suppose. You have spike. This is a spike all the way up to here, and then a pullback, and then a channel. And the beginnings of channels are often tested. So, we could, pretty easily get all the way back down here, and we're probably getting back to 5,000. So I wouldn't be surprised if we get all the way back down here, maybe next week. Probably, I would assume that would be a reasonable target for sometime next week. Yeah, that's today.